This is Al Brooks, and this is my price action trading course. This module is about my setup. It's pretty simple. I use a laptop computer, and it's not particularly expensive. It's a very average laptop. I use a 5-minute candle chart and a 20-bar exponential moving average, and I do not use any indicators. So, for example, here is a daily chart of the EWZ. I have a 20-bar exponential moving average. Since this is a daily chart, each bar is 1 day, so the 20-bar exponential moving average is a 20-day moving average in this particular case. On a 5-minute chart, the 20-bar exponential moving average would be 5 20-minute bars. When I look at the 5-minute chart, here's a 5-minute chart of PBR, Petrobras, and when I look at the 5-minute chart, I have my 20-bar exponential moving average, but I usually have 2 other moving averages as well. This one is also a 20-bar moving average, but it's based upon the 15-minute chart. So in other words, it's based upon 20 15-minute bars, and this other line is also a 20-bar exponential moving average, but it's based on the 60-minute chart. In other words, this line is exactly at the prices that I would see the line on a 60-minute chart. So it's helpful. So here you can see the market is forming a double top at the 60-minute moving average. So if this was a 60-minute bar chart, this would be right at the 60-minute moving average. I keep my blinds closed. I don't take calls, and I don't watch television. Occasionally I'll get a phone call from one of my daughters or one of my sons, and I'll take that call, but otherwise I don't take calls. And I ignore the news. I ignore the pundits. I know when there are reports at 7 o'clock or an FOMC report, and when the reports come out, I usually do not trade, at least for several seconds, maybe for several minutes. I don't care what the pundits say the report means. There's going to be a bullish case and a bearish case, and they're going to put one pundit on, and that pundit will be either a bull or a bear, and that's not telling me what the 200 or 300 firms on the who are trading aggressively think that the market is doing in response to the report. The only way I know how the market thinks the report is by looking at the charts. Pundit on television is only giving me one side. Also, I don't want any distractions, and I don't want anybody else's opinions. I just want to analyze what's going on myself. And I'm also very focused when I'm. What's my job? It's simple. It's to take money from other people's accounts and to put it into my account. And we're all playing the same game. We all, it's no secret. Everyone's trying to take money from everyone else. Goldman Sachs is trying to take money from Morgan Stanley. Morgan Stanley's trying to take money from Citibank. Hedge funds are trying to take money from everybody else. That's just the game that we're playing. I have a 60-40 rule. And sometimes on television you'll see someone insisting that the market is definitely going up or definitely going down, or some report is definitely bullish or bearish. Nothing works all of the time. Everything works some of the time. Most things work 40 to 60% of the time. So I think we live in a world where the probability is 40 to 60%. And Alan Greenspan once said that he was very proud that he was right about 70% of the time. So here he is, the chairman of the Fed, and he's making the rules, and he's controlling the game, and even with that, he could still be right only 70% of the time. So most traders are going to live in a world where the probability is 40 to 60%. If you think something is higher than that, you're probably wrong. If you think something is less likely than 40%, you're probably wrong. If things get outside of that band, there will not be institutions taking the other side of the trade. and they'll hammer it back into the band. Remember, the market stays pretty much in balance. There'll be an equal number, or approximately an equal number of institutions on one side as there are on the other side. And if the market gets too heavy on one side, it will regress toward the mean. Whenever someone says that he has something better than 60-40, there are certain pundits that they put on television who talk with certainty that something is going to happen. I never believe them. Whenever a person is that certain or confident, he is not honest, and he's out there selling something. Perfect trades cannot exist because there has to be institutions taking the other side. And if something was perfectly right, that means the other institutions would have to be perfectly wrong. And since these institutions are pretty much balanced on both sides, it would be impossible for that to happen. How can price action trading work if everyone knows it? Trading is very difficult to do. Even when you're very good, your margin for error is very small, and every mistake works against you. The best analysis is right only about 60 to 70% of the time. I often have days when I don't lose at all, right? That doesn't mean I'm 100% right. It just means I was, lucky on that day. Really good traders, for the most part, are not going to be right, more than 70% of the time, unless they're scalpers. I scalp most of the time. I do try to swing during the day, but most of my trades are scalps. And that's the only way you can get a high winning percentage. You're competing against the very best traders in the world, the smartest people in the world, and it's basically a zero-sum game. And everyone wants to take money from everyone else. Okay? There's a huge difference between knowing how to do something really well and playing it well enough to make a living. A soccer player, he may know how to play, for example, a coach, but that does not mean he's able to make a living doing it. You can know a lot about trading, but you have to have a lot of experience to be able to trade well enough to make a living. Who's the mark? In poker, you often hear about, that guy's the mark. And in poker, if you're playing poker and you're with on a table, 6 people, 8 people, and you don't know who the mark is, who the loser is, then you're probably the mark. And in trading, someone is always trapped on the wrong side of the market. And if you don't know who's trapped, you'll probably discover that you're trapped, that you're on the wrong side and you're holding a losing position. It's very important to understand that 60-40 rule. If you don't believe that the exact opposite can happen, the exact opposite of what you believe will happen, if you don't believe that the exact opposite can happen 40% of the time, you'll be trapped into bad positions and out of good positions. You have to be very fluid about this and with your beliefs. You have to change. When the market is giving you evidence that your current belief is wrong, just take the opposite belief. And there's nothing wrong with that. The market does that all the time. It's always reversing all day long. So it's you should change your opinion all day long, repeatedly. Can you get trapped out of a good trade? Sure. Here's a strong bull trend, right? And then you got several strong bars, and some bulls would have exited below this strong bear bar, especially since it's the second bear bar. And if you were one of those traders who exited out because of all these bear bodies, and then you see a potential buy signal, just get right back in. If you get trapped out, of a good trade, you just get right back in. You don't feel embarrassed about it. That's just the way the market works. It's always trying to trap traders out. And if you see that you were wrong in believing that the trade was bad, that a long trade was bad, and you got another buy signal, just go ahead and buy. Don't worry. This is the end of the module on my setup. This is Al Brooks, and this is my price action trading course. This module is about program trading. The markets are controlled by program trading, and you can only make money if you trade in the direction that program trading is trading. If the bullish programs are controlling the market's going to go up. You only make money if you're buying. If the bearish programs are in control, you have to be looking to sell. How do the programmers come up with algorithms? Any idea that you can imagine is something that a programmer has tested. Even when the market is in an extremely tight trading range, the volume is huge, and you have high frequency programs scalping for a tick or two. When the E-mini futures contract is in a tight trading range for an hour or two, and the top of the range to the bottom of the range is only 2 points, you have high frequency trading firms buying. Every time the market goes below the midpoint, they'll buy. It goes another tick or two, they'll buy more. At some point, it gets back to the middle of the range. They exit their longs. They break even on their first entry, and they make a tick or two on their second and third entries. It goes above the midpoint, they sell. It goes a tick or two higher, they sell more. It comes back to the midpoint of the range to their original entry price. They get out around break even with a profit on their later entries. On television, if you listen to television, it sounds as if Goldman Sachs controls the market. They do not. There are, at any given time, hundreds of firms placing trades, and Goldman Sachs is just a small part of it. And the market is, in general, balanced. So there are pretty much most of the time an equal number of dollars going into longs as there are going into shorts. Bullish programs are trying to create upside breakouts, and bearish programs are adding to positions, trying to create downside breakouts. Eventually one side wins and the other side covers. So for example, if the bulls are successful in creating a very big bull breakout, the bears who were shorting in the trading range will buy back their shorts. That adds to the buying and adds to the breakout, and those bears will not be eager to short again. So you'll have bears sitting on the sidelines not shorting, and that means the market has to go higher to find a price where they'll be willing to short again. So during breakouts, the market can become very one-sided. Now, the markets are controlled by programs, and they cannot hide what they're doing. The price action shows everyone exactly what's going on. So if the market is going up bar after bar after bar, you know the buy programs are winning and the sell programs are losing. And if you know that the buy programs are in control, then you have to get long or look for ways to get long. They cannot be stealthy about it. It's not like 50 firms are out there buying and the market is going up and they're doing it in a secret way. They're showing us what they're doing. If the market's going up, we know that there are more dollars going into buy programs than into sell programs, and that we should look to buy. You cannot move the market. Traders always think, oh my gosh, if I buy here, it'll make the market pop up. Or if I sell here, it'll make the market pop down. Or if I'm long and I put a stop below that bar, the market's going to see my stop and it's going to come down and get my stop. That is absolutely not true. The market cannot get to any price above or below where the market currently is unless one or more institutions wants to buy or sell at that price. Remember, the market, to be at any price, there has to be a buyer and a seller. So there have to be institutions wanting to sell there. It's not you or your friends wanting to sell on a stop below the low of the current bar or above or buy above a prior swing high. You cannot make the market get above that high. It only gets above that high if there is one or more institutions who want to buy above that high. So, the market totally ignores anything that you do. And you can say, well, I saw a breakout the other day in the E-mini and only 3 contracts traded. That's right. Sometimes that happens. Sometimes an institution will move the market with a 3-lot order. But you try to move it on a 3-lot order, you will not be able to do it. So if the market goes above a certain price and only 3 contracts are trading, you have to assume it did that because an institution did it, not because somebody at home did it. And probably there's a reason for that institution doing it. The institution may have wanted the market to go down and may have wanted to trigger traders into thinking that it was going up. And then as soon as they bought their 3 contracts, it ticked down maybe a tick. They then sold 200. So if you want to sell at any price, whether to get short or to get stopped out of a bad trade, the market cannot reach your price unless there are institutions who want to sell at that same price. The market's not going to go to your price no matter how big a position you have. The market's not going to go to your price because of you. It'll only get to that price if institutions want to sell at that same price. High-frequency trading firms, HFTs, have received a lot of publicity lately. They were on 60 Minutes about a year ago. And all a high-frequency trading firm is a type of program trading firm. They create most of the day's volume. In some of the big markets, they can create 50%, maybe even 75% of the volume of trading. And the firms scalp for tiny profits. What's a tiny profit? Sometimes a penny, sometimes less than a penny. And they'll be trading a huge number of trades. Ultimately, they don't have any significant effect on the direction of the market. They're just looking for a penny up, a penny down, 2 pennies up, 2 pennies down, and they really don't have any significant effect on what the market, where the market is going. A typical firm might trade 10 to 50 million trades a day, and the trades are small. They're only 100 contracts, 100 shares in a stock, 300 shares. But if you take 50 million shares and you're trying to make 1 penny, and you're right 55% of the time, you can end up having a pretty good day. Okay, they create 70% of the volume in most of the major markets. Other institutions create the 25% of the volume, and you and I, on a good day, might make up 5% of the volume. The high-frequency trading firms are really concerned about latency. Latency is the time from when a trade takes place to the time that they see the trade on their computer. And they rent very expensive space very close to the exchanges, and they have very fast computers to try to knock off milliseconds in the latency. They often hold their trades for fractions of a second, sometimes to hours, but for the most part for a very short period of time, and they're looking for a very small profit. I will talk about extreme scalping in one of the later modules, and that is a manual version of high-frequency trading. So, for example, the E-mini has 81 bars during the trading day, and on a typical day there are about 40 possible scalps. So if you're a scalper looking for all of those 1-point scalps during the day, you are basically a high-frequency trader, but instead of doing it using computers, you're doing it manually. Going back to what I was saying, that institutions make up 95% of the trading. They're not out to get your money. You don't have enough money to interest them. Remember, 95% of the dollars out there are from institutions. That 95% is not looking at the 5% as their source of income. Each one of the firms in that 95% are looking at the other firms in that 95% as the source of their income. None of the firms cares about us. Goldman Sachs is not trying to take money from you. They're trying to take money from Citibank, from J.P. Morgan, from Credit Suisse, from Morgan Stanley, from all of the hedge funds. That's where all the money is, and that's where they're trying to get their money. So, although a lot of times when you're starting out, it feels like they're trying to screw the little guy. They don't care that you exist. You don't have enough money. All the little guys put together do not have enough money to interest the institutions. So the institutions are never out to get you. High-frequency trading firms, how much profit potential do they have? For example, let's look at a firm that makes 10 million trades a day, and each trade is for, let's say, 100 shares, and they win 55% of the time. So they make a penny on 5.5 million trades, and they lose a penny on 4.5 million trades. Let's just use that as our hypothetical. Then they end up with 5.5 million winning pennies, which is $5.5 million, and they have 4.5 million losing pennies, or $4.5 million. So their net profit today, $1 million. Net profit per year, there are about 200 plus trading days a year. That's $200 million for the year. The high-frequency trading firms are just like you and me. They're out to chase riches, and they know that there's a huge profit potential, and that huge profit potential results in the formation of lots of firms chasing that profit. But there's a fallacy. Everyone thinks that all the high-frequency trading firms are making a lot of money, and that's not the reality. Many of them lose money, and only the very best firms do as well as in the example that I just gave. The high-frequency trading firms receive a lot of press, and the media makes it sound like if you're not making money, it's because of the high-frequency trading firms. The reason you're not making money is not that the high-frequency trading firms are the problem. It's because you're the problem. Everyone wants to blame everyone else for their losses. But if you lose, it's because you're not yet good enough. Everyone knows that the dollars are there. That's why all of us are here. We all want some of the dollars. We all want a lot of the dollars. But you're competing against very good people on pretty much a level playing field, and you have to learn how to trade if you're expecting to take dollars from other very good traders. This is the end of the module on program trading. This is Al Brooks, and this is module 4 of my price action trading course. And today I'm going to talk about the personality traits of successful traders. Everyone's familiar with the list of traits. There are many more than this. Some are fairly obvious. Being objective, being disciplined, being patient. The two last ones, I think, are probably the most important. Being comfortable with uncertainty and managing trades properly. Disciplined traders, they never say to themselves, maybe this time it'll work. I'll try it this time. Or, hey, maybe I'll try this. They don't try ideas out of the blue, whimsically, just because the market is setting up something that might be fun to try. They stick to their plan, and if a setup is not one that they normally trade, or if it's something that doesn't look quite right, they just don't take the trade. They just let it go. Disciplined traders, they never say to themselves, maybe this time it'll work. I'll try it this time. Or, hey, maybe I'll try this. They don't try ideas out of the blue, whimsically, just because the market is setting up something that might be fun to try. They stick to their plan, and if a setup is not one that they normally trade, or if it's something that doesn't look quite right, they just don't take the trade. They just let it go. And you're trading against computers, and you're trying to duplicate what they're doing. Institutions are mostly computer generated trades, and For you to make money, you've got to be doing what the institutions are doing and what the computers are doing, and they're not trading based on emotion. So if you're looking at a setup and you feel any emotion, don't take the trade. You also have to be very comfortable with the idea that the market might do the exact opposite of what you believe, and it'll happen about 40% of the time. It can happen more. If you're a scalper and you're extremely good, it can happen less. But you have to be open to the possibility that the market can do the exact opposite of what you think. Remember that anytime you take a trade, an institution agrees with you and another institution disagrees with you. And you cannot be so confident that the institution on the other side is wrong. That institution, no matter how confident you are, is going to be right 40% of the time, at least 40% of the time. So if you're a pretty good trader, you'll probably lose at least 40% of the time. You have to be willing to sit there and do nothing. If you're a day trader, sometimes you have to sit for an hour or two or three waiting for a good signal, and never get impatient and start telling yourself that, boy, a good trade is overdue. Maybe I'll take this one. A good trade is never overdue. Sometimes there'll be 20 or 30 good signals in a day, sometimes just 3 or 4. And if you want to end up positive at the end of the day, you'll just accept whatever the market is offering. And if it's offering very, very little, then you have to sit there patiently and do nothing. This is very important, the idea of being comfortable with uncertainty. Whenever you're putting on a trade, there's always uncertainty. The first obvious element of uncertainty is how likely will the trade be successful? What's the probability of success of achieving your goals? And then you're also going to be uncertain about where to put the stop. Do you use your routine stop, a money stop, like maybe 2 points in the E-mini, maybe 50 cents in IBM? Or do you have to use a bigger stop or a smaller stop? You're also going to be uncertain about your profit target. If the bars are very big and the range is very big and the swings are very big, maybe you should be using larger targets. And this is something that traders deal with all the time. And if you find yourself getting upset or anxious or feeling pressured that you don't have enough time to make the decision, don't take the trade, right? Because then you're feeling emotion, and you cannot make money if emotion is influencing your decisions, because you're trying to do what the computers are doing, and they are not trading based on emotion. You have to be comfortable with losses. They're going to come. If you're a pretty good trader, you're going to be losing at least 40% of the time. When you're trading, nothing is crystal clear as you're trading. And if you think something is crystal clear, don't take the trade because you're reading the charts incorrectly. At the end of the day, when you print out the chart, everything is crystal clear. However, that's not the case real time. There's always uncertainty. You also have to be comfortable with what you're doing. If this is your job and you're planning on doing it for many years, you have to be doing it in a way that's enjoyable. You can't be miserably stressed out all day long, worried about losing money, and worried that, oh my gosh, I just lost 3 in a row, I can't afford losing 4 in a row. If that's how you're feeling, you have to change how you're trading and find a method to trade where you enjoy what you're doing. I get up every morning and I just can't wait to get in front of my computer. I really like what I'm doing. For years, I was an extreme scalper, taking 40 trades a day. But it was really stressful. It was not fun. Can you make more money doing that? Sure. But, life has to be fun. You only have so many years, and if you're choosing to live them in a miserable way, I think that's not the best way to live your life. I think you got to, what you do with your life, time is precious, and every part of your life should be fun. And you can make money while being happy. There are lots of jobs where you can really love what you're doing and you can make a lot of money. And trading is one of them. You don't have to be miserably worried all the time. You have to find a way of trading that allows you to be happy. And there are lots of ways to trade, and chances are you'll be able to find one that suits your personality. Don't worry if you see someone on television who's trading one way and it's not right for you. That's okay. Every trader has a different personality, and every trader finds a method of trading that suits their personality. And the great traders don't worry that somebody else is using some other approach and making a lot of money. If that's not them, they don't worry about it. You have to be comfortable doing what you have to do. Swing traders, they lose most of the time, but they're going for rewards that are 2 or 3 times greater than their risk. And if they're comfortable with winning only 40% of the time, it's a great way to trade. In fact, it's probably the best way to trade when a trader is starting out. Other traders are comfortable scaling into trades going against them. So, for example, if the market is in a weak bull channel, they'll start selling above prior swing highs if they're confident that the channel is about to transform into a trading range or a reversal. But they have to be comfortable with growing open losses. The losses that they have continue to grow as the channel continues to go up. They also have to be confident in their read. They have to be confident that the channel is trying to convert into a trading range. And they also have to be able to stick to their plan. They can't panic and exit with a huge loss right before the market turns. They have to be trading with a size that will allow them to have the market go against them, sometimes for an hour or two. But as long as they're confident with their read and they're not trading so large that the losses are too big for what they're doing, that's a comfortable way to trade. There are other traders, scalpers, who want a very high probability trade. But anytime something has a high probability of working, chances are it's only going to work briefly. So the reward is going to be smaller. However, even if you're scalping for a small reward, you have to make sure that your risk, the distance to your stop, is no bigger than your reward. If you're trading with a stop that's bigger than your profit target, you have to be right 80 or 90% of the time, and that's very difficult to do. Some traders are comfortable with any type of environment, high probability, low probability, scalps and swings, and that's okay. And if you find yourself to be one of those traders, go for it. If that's your comfort zone, that's fine. Go for it. Managing trades correctly is, I think, the most important part of trading, and it's more important than spotting perfect setups. It's fairly easy to spot setups. It's fairly easy to spot really good setups, but it can be difficult to manage the trade correctly after you put the trade on. Most of the time, there's a profitable way to manage both a long and a short. So most of the time, at any given instant during the day, you could buy and make money. You can sell and make money if you manage your trades correctly. How can that be? Well, let's say you buy. And there's an institution taking the other side of that trade, and chances are they're profitable. So they have a profitable way to make money selling to you. But that's management, and you have to be able to do it well. So anyway, like I just said, at any given instant, a good trader usually can make money by either buying or selling if they manage their trades correctly. This is the end of Module 4. Thank you. This is Al Brooks, and this is my price action trading course. This module is about some things that you have to consider if you're just starting out as a trader. What's the big picture in trading? It's actually fairly simple. You buy at support and you sell at resistance. If you're long, you wait for a rally up to a resistance level, and you start to scale out of profits, and that creates a small pullback. If the market goes higher to another resistance level, you continue to sell out. If you're short and the market is going down, you're going to buy at a support level. And if you're flat and the market goes down to support, you look to buy. If you're flat and the market goes up to resistance, you look to sell. It's no secret. Just turn on television and look at Fast Money, Options Action, Money in Motion, Fox Businesses, CNBC, and listen to traders. That's all they do all day long is talk about, the market is coming down to a support level, or a gap down, but it's right at a support level. I think I'll buy. Or, we had this big bear breakout and now we're rallying, but it's testing the breakout point. I think I'll sell. You don't hear them saying, there's a dark cloud cover or a morning star or a Harami pattern. They're not talking about candle patterns. They're talking about support and resistance. Sometimes you'll also hear them talk about, the market is really strong. I'm going to buy, or I'm going to buy calls. The bull market, the market's racing up. So in other words, they see the market as in being in a bull breakout, and they buy. And they don't sell out at resistance because they assume resistance will fail. And they look for any reason to buy. They'll buy at the market. They'll buy a strong bear bar. They'll buy a strong bull bar. They don't care. They just know the market is going up and it probably will be higher, so they're going to buy. And then a strong bear breakout, they don't pay attention to candle patterns. They're going to sell because they know the market is going lower, or they feel strongly that it will, and they believe that all support will fail and that the market will just continue lower and lower and lower. And they'll look for any reason to get short, and you will never hear them, or only rarely ever hear them, talk about a candle pattern. So the context, where we are in the market cycle, the strength of the market, all the bars to the left, that's much more important than the candle patterns. Management is the key. You're buying at support, you're selling at resistance most of the time. During the strong breakout phases, which happen maybe 5% of the time, you're trying to get in the market immediately for any reason. If the risk is big, let's say the market's in a strong bull breakout and you see that the stop has to be far below where the market currently is, and you're afraid of taking a long, either you trade very, very small, or you use options. Options are an alternative to a very wide stop because your risk is contained. Also, sometimes you'll hear traders who are long on television, and the market has gone a long way, and the logical stop is far below, and they don't want to risk that much. So they'll replace their stock position with options. So they'll sell out of their stocks, take their profits, and then buy a call or buy a call spread because they don't want to risk to where they have to risk given how far away the logical stop is, let's say the most recent high or low. Beginners always want trading to be easy. Al, why can't you tell me what the perfect trade is? Why can't you tell me the perfect setup? I want to make money. I'm willing to work really hard. I'm willing to study. I deserve to make money. But it's not. What beginners fail to realize is that there are institutions on both sides of the market at all times. For you to be able to buy, an institution has to sell it to you. For you to be able to sell, an institution has to be able to buy the other side. And both the bull and bear institutions are profitable. And how can both make money if one side's buying and the other side's selling? There are lots of ways, but it all comes down to management. So, for example, if you're buying and a bear institution is selling, they might be willing to sell in more higher. They might be willing to scale in. They might be hedging and offsetting the position in another market. You just don't know. The bottom line is it's not going to be easy. Trading is always going to be hard because you're trying to take money from institutions, and the institutions are profitable, and there are institutions on both sides. So the margin is always going to be small. Beginners want an edge. They want to be able to buy some magical signal that's going to work all the time, or a very high percentage of the time, with very little risk. But if you think about it, if you're going to be able to buy with potential for a huge reward and very small risk and a high probability of success, there has to be an institution willing to take the opposite side of the trade. And the institution won't do it. And because there's no institution who will take the other side of your trade and willingly give you money, your perfect trade cannot exist. Also, traders feel like everything that they've done in life, if they work hard, they get paid. And if they work hard, they deserve to be paid here as well. Let's say they're a furniture maker and they make a chair, they get paid. If they make 10 chairs, they get paid 10 times much, 10 times as much for all their hard work. But that's not how the market is. You don't get paid simply because you work hard. So you can study all you want. You can learn candle patterns as much as you want. You can force yourself to be as disciplined as you want, but you don't deserve to get paid. It's like a 40-year-old baseball pitcher who made a fortune through his career, and now his 90-mile-an-hour fastball is down to 84 miles an hour, and batters just hit him like crazy. That 40-year-old pitcher can work as hard as he wants, but he's no longer going to get paid, because that's the nature of the business. And trading is the same way. You don't get paid for hard work. You get paid for being good. Life is not fair. You can look at people on television who appear to be rich. You can listen to people say Goldman Sachs makes a lot of money, or hedge funds make a lot of money, and therefore I deserve to make a lot of money. I'm a human being. I have the same basic human rights. I deserve to make money too, especially if I'm willing to work hard. But that is not true. You don't deserve anything in trading. Nobody does. And Goldman Sachs, they're as good as their last trade. If they start to lose, trade after trade after trade, they'll go out of business. Again, as I said, perfect trades do not exist. Beginners always want them. People are always asking me, Al, what's the best setup? There is no best setup. Look at the charts. The market is trading all day long, and that means institutions are buying and selling all day long. You make money by doing what they're doing. So you look to buy and you look to sell all day long. And you just try to find setups where there's an edge, where you have some advantage, where you can structure the trade and manage the trade in a way that will likely result in you being profitable. But even at your best, your edge is going to be small. So first of all, you have to get good enough so you have an edge, a mathematical advantage, a mathematical likelihood that if you do what you're doing 100 times, you'll end up with a profit. And your edge can come from taking low probability trades. So you can be right 40% of the time and lose 60% of the time and still make money if your system results in taking winners that are several times greater than your losers. Candlestick patterns, I think they're a fraud. I was looking at the internet the other day and Google searching how to trade to get ideas about what my competition is doing in terms of courses, and it looks like everyone is pushing candlestick patterns, and it's as if that's the way to make money, and it's not. Look at traders on television. When's the last time you heard a trader talk about a candlestick pattern? They don't talk about them. Goldman Sachs and hedge funds, they're not using candlestick patterns. High-frequency trading firms, they're using tick charts. They don't even see candlestick patterns. Candlestick patterns are being sold by false prophets as a means of taking you to, trading heaven, and that's just not the case. They give you false hope, and that is not how traders make money. A setup is composed of two things: a candlestick pattern, in other words, a signal bar, or a signal collection of bars, and a context. Context is everything to the left, and that is far more important than the signal bar. For example, if the market's in an extremely strong bull trend, it doesn't matter what the candlestick pattern shows. You're going to buy. If it's a strong bear bar, you're going to buy. If it's a strong bull bar, you're going to buy. If it's a weak bull bar or a weak bear bar, you're going to buy. The context overwhelms the candlestick pattern. On the other hand, if it's in a pretty strong bull trend and you're looking to sell, you only want to sell if you see a very strong bear reversal bar. Most of the time, starting out, you should not be giving any thought to selling in a strong bull trend or buying in a strong bear trend. You'll lose money. Trading, it takes years to get good, and you will lose money for years. Most traders lose forever. However, we're all attracted by the lure of making a lot of money and being able to get a multiplier effect. When I was an eye surgeon, I could do one operation at a time. I could not do 10 or 100 at a time. As a trader, I can trade one contract, but I can also trade 10 contracts or 100 contracts. And everyone is intrigued and lured by the possibility of becoming rich. And that's why we're all here. It's fun, and the upside is huge, and we want to find out if we can do it. We know that people do it. Goldman Sachs, hedge funds, a lot of them are very rich, and that's why we're all here. We all are attracted to the possibility that we can figure it out well enough to become billionaires. And that's okay. But you have to remember that everyone loses for years, and that most traders who try this end up losing forever. And if you're looking for perfect trades and profits to take you to salvation, you will lose. The only way to win is by doing it yourself. Learning enough to do it. Learning some successful systems, and being disciplined and doing the right thing day after day. So, what kind of chart should I be using? Price action techniques work on all types of charts because the movement on charts is simply a reflection of human behavior, and any chart captures that behavior. For most traders, a good starting point is a 5-minute chart, or maybe even a 15-minute chart, assuming they can trade small enough so that the increased stop size does not cause them to put too much money at risk. My rule of thumb for somebody starting out, in fact for anyone, even very experienced traders, is to avoid any chart with more than 20 bars per hour. So that would be a 3-minute chart. Most traders should not be even trading a 3-minute chart. And they certainly should not be trading a 20-tick chart or a 500 share chart or a 1-minute chart or a 2-minute chart. Why not use a small time frame? High-frequency trading computers use the smallest time frames. They use tick charts, and many of them make a lot of money. The risk is obviously very small, and if you have a winning system, why not use it 10 to 20 times a day or 50 times a day instead of just 3 or 4 or 5 times a day? You can do manual high-frequency trading. Paul Rotter does hundreds of trades an hour by hand. And there are some day trading websites that recommend trading on a 1-minute chart or a 20-tick chart in crude oil or in the currencies. This is simply manual high-frequency trading, and if your techniques are good, you can make a fortune, and that is absolutely correct. However, there's a problem. 99% of great traders cannot make money using them year after year. And if you try, your account will slowly or quickly disappear. And why is that? Why not trade on 1-minute chart? What's the problem with a 1-minute chart? The risk is very small, and that's very appealing to beginners because their accounts are small, and the one thing they're most concerned about is risk. And if they trade a 1-minute chart, the stop is closer to their entry price, and their risk is less. And the logic is great. If you have a winning system, why not apply it 20 times, 50 times a day, 100 times a day? You'll make that much more money. Time is the problem. Deciding to take a trade takes time. Deciding how to manage your trade takes time. And our brains are not designed to make that many decisions correctly in so little time and to make them so many times a day. I'm a very smart guy. And years ago, I could trade the 1 and 2-minute chart, but it was very hard. Plus, it was not fun, and I was not making any more money than when I trade the 5-minute chart, because it's really hard to do. You end up cherry picking, especially after an hour or two of trading. You get tired, you lose focus, and invariably, once you start to cherry pick, you'll find that you tend to pick all the bad cherries. They look great, but they tend to end up being the worst ones. The way the market is structured, it's always going to generate the most pain. So the trades that look the easiest usually are losers. and it's very hard to make the decision when you have very little time. And so if you're trading a 1 minute chart, you're giving yourself seconds by the time the bar closes to make a decision whether or not to take the trade. And it's simply not possible for 99% of successful traders to do it well, day after day, year after year. So those websites that promote that kind of trading, it sounds great, little risk, big profit. The reality is very few traders can do it successfully, for a career. We're not talking about doing it successfully for a few days or a week or even a month. We're talking about doing it for 10 years, 20 years, 30 years. And I think most traders simply cannot do that, and it's not worth it, because you can make a lot of money doing something else, and you'll enjoy what you're doing much more. What's the alternative? Well, before trying a 1 minute chart, first prove that you can be profitable, consistently profitable on a 5 minute chart. And if you can, simply work on increasing your volume, the position size. And in the end, you'll make far more money than by reducing your time frame and increasing the number of trades. Taking 5 to 10 trades a day on a 5 minute chart for most people is going to be vastly much more profitable than taking 20 or 30 trades a day on a 1 minute chart. In fact, you will lose money if you try trading 1 minute charts. First of all, you should be very selective, and don't worry that some traders take 10, 20, 30 trades a day. If you take simply the 1 to 3 best trades a day, you're in a good position to make money. What are the best trades? I have a module on best trades later in the course. Once you become consistently profitable, it's better to increase the size of your position than it is to increase the number of trades. Once you have the ability to spot really good trades and you're consistently good at trading them, if you do the math, you'll see that you can do very well if you just stick to the several best trades that you see each day. For example, if you were to average just 1 point a day in the E-mini, or 10 cents a day in the Spider, and you trade 10 contracts, 10 E-mini contracts per day, making 1 point a day, that comes out to $100,000 a year. If you trade 25 contracts, $250,000 a year. If you trade 100 contracts, $1 million a year. If you make 4 points a day on 100 contracts, that's $4 million a year. So you're starting to make income comparable to professional athletes. The key to making money, you have to follow what the institutions are doing, and you have to have the attitude that I don't care. That's absolutely critical. You cannot care about anything. You have to be totally devoid of emotions when you're trading. Remember, most of the institutions that you're trying to follow have their trading done by computers. Maybe half of the volume is traded by high-frequency computers, high-frequency trading programs, and maybe 25% is done by other computer trading. And all of the computers use every conceivable variable in their algorithms. They're all based on math. Emotions are not a variable. They don't place trades based upon fear or anxiety or worry or hope or wish. Right? Emotions are not part of what they consider. So if you're feeling emotions and the emotions are influencing your trading decisions, you are not doing what the computers are doing, and it'll be very, very difficult to make money. So feeling worried, hopeful, you're restless, you're carefree, you're tired, if you have any feeling at all, if it's interfering with your judgment, then don't take the trade. You have to get to the point where you really don't care. You don't care about anything. Now, I understand that feelings, you're always going to have feelings, but you have to get them to the point that they don't interfere with your decisions. And there's one important thing that you can do to minimize the effect of feelings on your decision making. And that is you have to trade small enough so you honestly do not care. Okay? If you care, you will not be objective. If you care, you will not follow the institutions. If you care, you will lose money. If you care, that usually means you really want to win, or you really hate to lose, or you're afraid of losing. It will make you lose money, and the only sensible way around that is to trade small enough so that if you lose, you don't worry, and if you win, you're not all excited, or you're not desperate to win. So you just trade small enough so that you can remain objective and your emotions don't interfere with your trading decisions, and especially with your management of your trades. And that is, you have to trade small enough so you honestly do not care. Okay? If you care, you will not be objective. If you care, you will not follow the institutions. If you care, you will lose money. If you care, that usually means you really want to win, or you really hate to lose, or you're afraid of losing. It will make you lose money, and the only sensible way around that is to trade small enough so that if you lose, you don't worry, and if you win, you're not all excited, or you're not desperate to win. So you just trade small enough so that you can remain objective and your emotions don't interfere with your trading decisions, and especially with your management of your trades. Can anyone really make money doing this? Absolutely. They can do it, but it's always going to be difficult because you're trading against the best traders in the world. Anytime you take a trade, there's an institution taking the opposite side of the trade, betting that you are wrong. So whatever edge you have is always going to be small. So you have to have very good discipline and very good trade management to make money long term. But some people make a lot of money. Do a search on Paul Rotter, and you'll get an idea of, or also he's in Wikipedia, you'll get an idea of just how much money a day trader can make. Here are a couple links, and supposedly he was making about $60 million a year as a day trader. And sometimes he would place hundreds of trades an hour in the currency markets, just trying to make a few ticks on each trade. So he was doing high-frequency trading by hand. He was a manual high-frequency trader, and he was very successful at it. All right, that's the end of this module on starting out. Thank you. This is Al Brooks, and this is my price action trading course. This module is about the market cycle. The market's in a never-ending cycle, alternating between being in a trend and a trading range, and then a trend again. When it's in a trading range, it can break out in either direction. The trend can be up or down. It does not matter what the direction of the trend was before entering the trading range. Every trend is composed of a breakout phase, which is an initial big trend bar or series of trend bars, and then a channel phase when the market starts to have pullbacks but still contained between a couple of lines. Channels eventually get flatter and broader and become trading ranges. Trading ranges eventually break out. And if you look at any trading range, you can usually see the beginnings of both a bull trend and a bear trend. The market may have a lower high and it may have a higher low. The lower high may be the start of a bear trend. The higher low may be the start of a bull trend. And at some point, the market breaks out and one side wins. Usually, you look for signs of buying or selling pressure within the trading range to get an idea of which side is more likely to win. You can view a trading range as a transition between trends. So you have a trend, the market pauses, hesitates, and then decides what to do, and then it becomes a trend. So the trading range is a transition between trends, but a trend is a transition between trading ranges. There's a trading range, and then the market decides the price is wrong, and it has to quickly move to a new price level, a new value level. It might be up, and then a new trading range. It might be down, and then a new trading range. The trend can be strong, like a breakout, a series of very large bull trend bars, for example, in a bull trend, or it can be weak and contained within a channel, overlapping bars and pullbacks. Trading range can be as small as a single bar pullback, or it can be as large as the entire screen. When a trading range is small and it forms within a trend, it's called a pullback. And when it's a pullback, it's part of the trend. It's a pause in the trend, and you believe that the trend will resume, that the breakout will be in the direction of the trend. When a trading range lasts a long time, 20 bars, 30 bars, 40 bars, it loses its direction. The trend is too far in the past, and the effect that the trend has on the market is too remote. And at that point, the breakout can be in either direction. The trading range means that the trend has lost its influence over the market. The trading range can end up being a continuation pattern leading to a resumption of the trend, or a reversal pattern. In fact, all reversal patterns are related to trading ranges. Head and shoulders tops, for example, are trading ranges. A pullback is simply a small trading range that is a pause in a trend, and you're assuming that the trend will resume, usually within a bar or two, sometimes 20 or more bars. And on a smaller time frame chart, a 1-bar trading range, for example, on a 60-minute chart, could be a 12-bar trading range on a 5-minute chart. Again, if the pullback grows so long that it loses its direction, you look at it and you say, well, I don't know if it's going to break to the upside or the downside. At that point, instead of calling it a pullback, you call it a trading range. And all pullbacks are trading ranges on smaller time frame charts. All trading ranges are pullbacks on higher time frame charts. If you have a trading range that is 36 bars long on a 5-minute chart, it could simply be a 3-bar pullback on a 60-minute chart. This is an example of what I'm talking about. This is the weekly S&P chart. This is the spider. And the green boxes are trading ranges. And I'll look at the first one here. So we have a trading range. We had a bull trend leading up to it, and then a trading range. And the market broke out in the direction of the trend, bull trend, right? So we had a bull breakout. And then within that bull trend, we have another trading range. However, this one broke out in the opposite direction. So sometimes the trading range will break out in the direction of the trend. Other times it will break out in the opposite direction. Here, on the left, we had a strong bear trend, and then a trading range, and then a breakout. However, within 3 bars, the market reversed. The breakout failed. So the trading range can break out in the direction of the trend, it can break out in the opposite direction, it can break out in one direction and then reverse and go in the other direction. All trends begin with a spike. You can call this single bull trend bar the spike, or you can call this series of bull trend bars a spike. As soon as it begins to have a pullback, it's entering a channel phase, a more two-sided phase. So we have a spike and then a channel, and usually the channel begins with some kind of a pullback. Again, you can view trends as just transitions between trading ranges. Here's a trading range, then a trend, and then another trading range. And you can view trading ranges as transitions between trends. We have a trend, a pause, and then another trend. Channels usually become broader and flatter, and at some point they lose, the pullbacks become so long that they lose their directional predictive ability, and then you look at it and you say, well, I don't know, maybe we're forming a double top bear flag and we're going to break to the downside. We have a low and we have a lower low, we have a lower high. Maybe this is the start of a bear trend. If the market did end up down here, you would look back and say the bear trend began here. So, in fact, this is part of a bear trend. Here we have a higher low. If the market goes up, you'll look back and say the bull trend began over here. So within this trading range, the market is in a trading range. It's also in a bear trend, beginning of a bear trend, and it's also in the beginning of a bull trend, and that's very common. Trading ranges usually have trends within them, and if you have both a bull and a bear trend, one will end and the other will succeed. Here's another trend. We have a higher low, right? So we have a trend and then a trading range, and we have a higher low and a bull spike. if the market ended up here, you'd say the leg began over here. So this is actually the first leg of a new bull trend. A spike, maybe we have a pullback, maybe we'll get a channel up, right? But spikes don't always succeed. In fact, most breakout attempts fail. Here we have a bull channel, and we tried to break to the downside, and it failed. Here we have a trading range, and we broke to the upside, and it failed. Here's the same chart showing that within every thing that you saw on the prior chart, there are nested patterns. There are smaller versions. So within this channel, there's actually a spike and a smaller channel. Here's a spike. This trading range is also in a channel. On every time frame, the market is both in a trend and in a channel. You can look at any segment of the chart, and if you go to a higher time frame chart, it's something else. So here we have a bull trend, but for a while we had the start of a bear trend. In fact, you could call this a small bear trend. And it's also a trading range. And within every trading range, there will be trends. Here's a small spike and channel. Every part of the chart is always either a trend or a trading range. Every bar is either a trend or a trading range. Here's a 1-bar trend. A doji bar, it's a small body, it's a 1-bar trading range. So everything is either in a trend or a trading range on every time frame, every type of chart. It doesn't matter. You have to understand that this is what the market does, and if you know where you are in the market cycle, you can use trading techniques that are appropriate and give you a better chance of making a profit. So if you're in the spike phase of a trend, once you decide, yeah, this is going up, you have to get long, right? You cannot say, well, maybe I'll wait for a pullback, because sometimes the pullback does not come for a long time. Here's another example. Yes, it's in a trading range, but we're starting to get a series of bull bars, and we broke out of this bear channel. Once you decide that, yeah, I think the market's always in long, you have to get long, because sometimes the pullback does not come for a long time. Once you decide that it's in a trading range, you have to decide, well, it's probably going to go up and down for a long time. I better buy low and sell high, and I better not hold my position for long, because it'll come back to my entry price. So if I buy here and hold, it comes back here. So once you decide it's in a trading range, you got to buy low and sell high. You can sell high to take profits on your longs. You can also sell high to go short. And when it comes down again, buy low, sell high. You buy back your shorts to take a profit, and you also might buy to go long. But if you hold, invariably the market will come back to your entry price. So if you bought here and held, it would come back to your entry price, and your profit would disappear. If you sold here and held, it would come back to your entry price, and your profit would disappear. So the best way to trade in a trading range is to scalp. Buy low and sell high. Here's a 60-minute chart showing a spike phase, a strong bull trend, followed by a channel phase, a weak bull trend. And channels are usually followed by trading ranges. The channel evolves into a trading range. So we have a bull channel, and then more sideways, and the entire screen becomes a trading range. Within the trading range, there's a bear spike, a gap, and a series of bear bars, followed by a channel down. And then there was a bull spike, a series of very strong bull trend bars, and then a broad bull channel. And within each part of the trend, there are smaller elements. There are nested patterns. So within the channel, there's a bear spike going down, here's a bull spike going up, and a channel. A bull spike and a channel. There's a bear spike, and within the channel, there's another bear spike, and then a smaller channel. Why is it important to know about the market cycle and where we are in the market cycle? Because each part of the cycle has different trading opportunities. And if you know where you are in the market cycle, a breakout phase, a channel phase of a bull trend, the approaches that you use to trading are different from those that you would use in a trading range. in general, I try to turn everything into binary decisions. I try to give myself just two choices. You know, when you're trading, you want to think about as few things as possible. And one way to do that is to try to structure your analysis in a way so that every decision only has two possibilities. An example of a binary decision in a bull market is whether the bull trend is a trend within a actual bull trend, or is the rally simply a leg within a trading range. And that's important to distinguish because you trade those two rallies differently. In a bull trend, you're only looking to buy, and you should be swinging at least part of your trade. If it's a bull leg within a trading range, it's good to take the buy signals. However, if there are strong sell signals, especially if there are second entry shorts, you can take those as well. And within a trading range, in general, the focus should be on scalping instead of swinging. In a strong bull trend, that's the breakout phase. I also call it a spike. You need to get long immediately. You should, in general, if it's a bull trend, you should buy at least a small position at the market. A lot of times you look at it and you say, wait a minute, the spike is so big, my stop has to be far, far away. That's right, that's where your stop has to be. But the reward is so large that it's worth it to take at least a small position and use the wide stop. When the trend weakens and it enters a channel phase, if it's a very tight channel, it's essentially it is a breakout on a higher time frame chart. It's a spike on a higher time frame chart, and you should trade it exactly like a breakout. So when a channel is very, very tight and very vertical, very small pullbacks, trade it just like a breakout, a strong bull trend, and only look to buy. If the channel starts to get broader and flatter, less vertical, with bigger swings up and down, you should always make sure to take the buy signals if it's a bull channel. But if the swings are very big and it's basically a trading range that's sloped only slightly up, you can trade in both directions. And in that case, the more it resembles a trading range, the more you should trade it like a trading range. BLSHS, buy low, sell high, and scalp. If the market's going down, also binary decision. It's a bear trend or it's a bear leg within a trading range. And again, you trade them differently. If it's a bear trend, only look to sell and try to swing at least part of the position. On the other hand, if it's a bear leg within a trading range, you definitely should take the sell signals. But if the buy signals are strong enough, especially if there are second entry buys, you can take them as well. And again, if it's a trading range, it's better to be scalping. If the market's in a very strong bear trend, the breakout phase, the spike phase, you need to get short immediately. If you can't figure out how to get short within the next minute or two, sell at least a small position at the market and put your stop at the top of the bear spike. It's a very wide stop most of the time. When that's the case, just trade small and then look to enter more as the trend progresses. If the trend is a weak bear, in other words, if it's in a channel, it depends if the channel is tight or broad. If it's very tight with very small pullbacks and it's very vertical, then trade it exactly like the breakout phase, the strong bear trend, and only look to sell and try to swing. If it's a broad channel, you make sure to take the sell signals because it's still a bear trend. But if the swings are big, trade it like a trading range. Buy low, sell high, scalp, and take trades in both directions. That's the end of this module on the market cycle. Thank you. This is Al Brooks, and this is my price action trading course. This current module is about buying and selling pressure. Bars often show that either the bears or the bulls are stronger, and the price action that favors the bulls is called buying pressure, And when price action favors the bears, it's called selling pressure. Both the bulls and the bears are constantly trying to create pressure. The bulls are trying to buy enough to make the market go up. The bears sell to make the market go down. And their activity creates footprints, and those footprints indicate pressure. When there is a preponderance of buying pressure in a bull trend, it's clear that the bulls are in control, and the clarity is due to the buying pressure. So when you look at a bull trend, you know the bulls are in control, and you know because you're looking at buying pressure. There are signs that the bulls are in control and that the market's in a bull trend. What are some signs of buying pressure? Here's a list. I'm not going to go through the list all in one part. I'll do it in sections. One of the obvious indications that the bulls are in control is that there are more bull bars on the chart than there are bear bars. And the bull bars on the chart are bigger than the bear bars. And there are often consecutive bull bars, like 2 or 3 or 4 consecutive strong bull trend bars. Small tails on top, big bodies. The bars tend to close near their highs. The tails on the tops of the bars are small or non-existent. There are also series of bars where there are no pullbacks at all, microchannels, bull microchannels. There are tails at the bottoms of the bars. When the bars sell off, going into the close of the bar, they buy it, and that puts the close higher up in the bar, and it creates a tail at the bottom of a bar. There are also breakout bars with gaps and follow-through. So when a bull bar closes above the high of the prior bar, that's a gap between the close of the bull bar and the high of the prior bar. There's follow-through. The next bar is a bull bar. Also, as buying pressure increases, it's represented very often by a number of consecutive bull trend bars. So you might get 2, 3, 4, 5 consecutive bull trend bars. Also, the bull bars start to get bigger, and the bodies start to get bigger. Also, the number of consecutive bear bars decreases. So, for example, 20 or 30 bars ago, there may have been 2 or 3 bear bars, and now you rarely see 2 bear bars in a row, and the bear bars tend to be getting smaller, and the bodies tend to be getting smaller. Selling pressure in a bear trend. When you look at a bear trend, you know that the bears are in control. The market's going down and to the right, and you know that's due to the bears. And the reason why you look at the chart and it's clear to you that the bears are in control is selling pressure. Again, here's the list that I'll be going through of things that are evidence that the bears are in control. Every one of these things on the list is an example of selling pressure. The first obvious example is if there are more bear bars than bull bars, that's a good sign of selling pressure. And if you start to get a series of 2, 3, or 4 bear bars, also if the bear bars are bigger than the bull bars, the bodies, if the bodies of the bars are bigger than the bull bodies, that's a good sign of selling pressure. Are most of the bars closing near their lows? Are we starting to see bear microchannels? 4, 5, 6, 7 consecutive bars without any pullbacks? Are there tails on the tops of the bars so that the market is trading up as the bar is forming, and then going into the close, it trades down and it creates a tail at the top of the bar? Are there bear breakout bars with gaps? In other words, is the close of the current bar below the low of the prior bar? Is there a gap between the close of the current bar and the low of the prior bar? Is there follow-through? Is the next bar a bear bar, and the bar after that a bear bar? Increasing selling pressure. Are we starting to see a series of bear bars in a row? Was the last time we had consecutive bear bars when we had 2 in a row, and now we have 4 or 5 in a row? That's a sign that the selling pressure is increasing. Are the bear bars in the past 10 bars having bigger bodies than those 20 or 30 bars ago? More selling pressure. Also, Are we no longer seeing consecutive bull bars? Are the bull bodies getting smaller? In other words, are the bears taking control over more and more bars and the bulls losing control? Within a trading range, both the bulls and the bears are fighting for a breakout. The bulls want an upside breakout, the bears want a downside breakout. A lot of times as the trading range is forming, you can assess the amount of buying pressure and selling pressure to get an idea of which side is more likely to win the fight. And it can help you anticipate the direction of the breakout and allow you to enter early. Bull bars are owned by the bulls. So every bull bar, I think of it as owned by the bulls. Here's a green highlighted area to represent a bull bar. Bear bars are owned by the bears. The more bear bars, the more selling pressure, the more likely there'll be lower prices that follow. The more bull bars, the more buying pressure, the more likely there'll be higher prices that follow. In a bull trend, the bulls are clearly in control and you should expect higher prices. In a bear trend, the bears are in control. They own the market and you should expect lower prices. Always in is a concept that I use when I'm trading. And what is always in? If you were forced to enter the market at this very moment, long or short, and you had to choose buying or selling, and you absolutely had to do one or the other, your choice is the always in direction. So if you look at the market and say, gosh, I'm not really sure, but 20 bars ago there was a pretty good bull spike, therefore I would buy. The market's at that point always in long. When the market's always in long, that means more dollars are on the buy side and the market's likely to go higher and you should look to buy. When the market's always in short, there are more dollars going into the sell side, generating more selling pressure. Lower prices are likely to follow and you should look for opportunities to sell. Whenever you know the always in direction, you try to enter the market in that direction either immediately if the market is extremely strong or on a small pullback. And if your stop has to be very far away, then trade very small. But make sure to get in. Whenever you feel confident that you know the always in direction, you really need to be in the market in that direction, even if you have to trade very small. For example, when the market had this huge bull bar, followed by 3 more bull bars, somewhere in here, most traders would look at that and say the bulls are controlling the market. The market's going to go higher. Look at this bar, this second bull bar here. Its close is above the high of the prior bar, so there's a gap. And also the low of the bar after it is above the high of the bar before it. So to me that that is a gap, and it may end up being a measuring gap. Signs of buying pressure: big bull bodies, consecutive bull bars, bars closing near their highs. Not everyone, but there are a couple here, very big bull bars closing near their highs. Tails on the bottoms of the bars, buying at the bottom of the bar. Here's another gap. The high of this bar and the low of the bar 2 bars later, or 3 bars later. Anytime the market is forming gaps between the low of a bar and the high of a prior bar, that's a sign of buying pressure, and it usually results in higher prices. Here's Baidu again, the same ticker that I used on the prior chart, and there was very strong buying pressure early on, but it was followed by a relentless bear channel. And at some point in here, you'd look at the chart, maybe not here, but over here, you'd start looking at the chart and thinking, the bulls have lost control, the bears are in control, the market's probably going down at least a little bit lower. So somewhere in here, you're deciding that the always in direction is down. Look at these 2 bear bars here. and look at the low of this bar and the high of that bar. There's a gap between those, between that low and this high, and it could end up being a measuring gap. Here's another gap here. Again, a sign of urgency on the part of the bears. So what you're seeing here is big bear bodies, consecutive bear bars. There are 4 in a row here, and there are 6 or 7 in a row here. Bars closing near their lows, okay? Tails on the tops of bars, and gaps, bear gaps on the way down. The low of the prior bar is above the high of the following bar. Low of this bar above the high of this bar 2 bars later, so there's a gap in there. All signs of selling pressure, all signs that the bears are in control, that the market is always in short, and that you should be short at least a small position. When the market's in a trading range, it's mostly sideways. But within the trading range, if you notice more buying pressure, then a bull breakout becomes more likely. If there's more selling pressure, then a bear breakout is more likely. So it's important to try to assess the amount of buying and selling pressure that's taking place within the trading range. If buying pressure is dominant, you expect a bull breakout, and the market is probably always in long, even though the market's within a trading range. You know, always in means you have to choose. You have to take a position this instant. What would it be, long or short? And if you see more buying pressure than selling pressure, your conclusion is it's always in long. Okay, here we have a trading range, but within the trading range we have this very strong bear spike, but then look what's taking place over here. We have 3 consecutive bull bars. Look what happened to the bear bars here, right? You can say, well, it went down for 6 consecutive bars. It did, but here's a bear bar. Look at the follow-through, not a bear bar. It's a doji bar. Here's the bear bar. Look at the follow-through, a doji bar with a bull body. A bear bar and a doji bar. So we have a bull leg here with 3 consecutive bull bodies, but the bear leg did not go down as far as the bull leg went up. You know, it did not reach the bottom of the bull spike, and the bears were no longer able to string together consecutive strong bear trend bars. And then over here, look what's taking place here. We have 4 consecutive bull bars, and the 4th bull bar has a bigger body than the prior ones, and there are gaps. This bar has a gap. The low of the prior bar above the high of this bar. The low of this bar above the high of this bar. So the market is starting to gap up. So yes, we're in a trading range, but we're starting to accumulate strong buying pressure. The bulls are starting to take control over the market. And this is what followed. So this is where we were. At that point, you thought always in long. Buy small, buy something, and put your stop below the most recent higher low, and take a chance that the market is going to go up, and go for a swing. You remember we had those 4 consecutive bull bars, closes near their highs with gaps, a sign of a lot of buying pressure, even though the market was in a trading range. So you don't have to wait for the breakout. You can wait for the breakout and then trade it like a breakout. I have a module that talks about how to trade bull breakouts, but within the trading range itself, if you're starting to see the market being taken over by the bulls, you can get long earlier because you decided that the market had become always in long. Here's another example of a trading range. Today occurred on a day with a gap open. We gapped down on the open, and then we had 4 consecutive bear bars. But notice what happened after that gap down and the bear spike. We formed a trading range, but within the trading range we had a series of 3 consecutive bull bars here, again here, and again here. Now look at the series of bear bars. You know, 1 bear bar here, 1 there. Where are the consecutive strong bear bars? Here are a couple here, but then a bull bar. Here are 4 here, but 2 of them had very small bodies. Here we have 4 consecutive bull bars, a bear bar, and then 3 consecutive bull bars. So 7 of 8 bars here have bull bodies. So we're, I think, accumulating some buying pressure. The bears want the trend resumption. They want small double top bear flag. But look at the signal bar, a bull body, not good. Signal bar here, bull body. Something's wrong with the bear case. Bulls want a double bottom and a higher low major trend reversal. Right here, this is a higher low major trend reversal. They're trying to get a double bottom. You can call this also a higher low major trend reversal. Okay, 4 good-sized bull bars and good-sized bull bodies. For the bears, it's a failed breakout of the top of the trading range, a test of the gap, a double top with the first bar of the day. But look at the signal bar, a bull bar closing on its high. Not a reliable signal bar. We have 4 consecutive bear bars here, but they're small and a tail on the bottom of the bar. And they're also holding pretty much above the moving average. So the bulls are looking at this thinking that this is simply a pullback from this bull breakout. Look, we got a low. We have a low back here, a higher low, a higher low. The bulls want another higher low. We have a high, a higher high. We have a high, we have a higher high. So we're starting to get higher highs and lows. Bulls want this sell-off to stay above this low. So bulls are buying right in here, putting a stop below the prior higher low, taking a chance that this trading range is evolving into a bull channel. This is what followed. We had a bull inside bar, a reasonable signal bar for the pullback from this breakout. That's a reasonable long, looking for another leg up. And look at the strength that we had here. A series of 7 or 8 or 9 consecutive bull bars, and several of them large. So we had a bear trend, a trading range, and instead of resumption down, we had a reversal up. When there are more bearish footprints, the selling pressure is dominant, and a bear breakout is more likely, and the market is always in short. Traders should look to sell. Here we had a rally on the open, and then we entered a trading range. And we had a good bull spike here, but a very strong reversal down. We had a tail on the top of the bar. We had a couple consecutive strong bear bars. We had small tails on the bottoms of the bear bars here. We had closes near the low, and little or no overlap between adjacent bars. And we also had gaps. Here's a bear bar, and look at the high of the bar after it and the low of the bar before it. There's a space in between, so a gap. Here's another gap. Here we're breaking out below the bottom of the trading range, and we have a big bear bar, and the high of the bar after it and the low of the bar before it do not overlap. So this might end up being a measuring gap. So the selling pressure, we had decent selling pressure all through this trading range, so it was pretty neutral. But when we started to come down here, the bears were getting stronger. Channels become trading ranges, usually. Usually they become increasingly two-sided to the point that they're no longer a bull trend and the market is sideways. Bull channels, they get increasing selling pressure, and that is a sign that they may soon evolve into a trading range. A bear channel, when it starts to develop increasing buying pressure, that's a sign that it may evolve into a trading range. Here's a very strong bull spike, and then we're starting to channel up. Okay, 2 very big bull bars. This breakout, smaller bull bars. We got some smaller bars here, and now we're in a tight trading range, and we're starting to get some bear bars. So this might be a bull trend, a strong bull trend, a weak bull trend, a bull channel, evolving into a trading range as the selling pressure is increasing. Here are some signs of selling pressure. We've got some bear bars here, lack of bull bars here, increasing number of bear bars here. A wedge bear flag. We have a push up on this bull bar, another push up here, and a third push up here. possible a lower high major trend reversal. We broke out of the channel. The bottom of the channel is a bull trend line, so that means we broke below the bull trend line. And now we have a weak rally in the form of a wedge. So this might be a lower high major trend reversal. A bear bar, so a possible signal bar for a short. And this is what followed. We had a bear spike, certainly tradable, and ultimately our bull spike, our bull breakout, was followed by a bull channel that evolved into a trading range. So the channel usually becomes the first leg of the trading range. So a bull leg, and then a bear leg, and now a bull leg. This is some buying pressure in a bear trend. We're in a bear channel. We're forming lower lows and lower highs. And it's a pretty strong bear channel, but we might be getting a third push down. 1, 2, 3, so it's possible. Effectively a wedge. Whenever you get a low 2 short, here's the first push up, second push up, so that's a low 2. When you get a low 2 late in a bear trend, you always have to be thinking about the possibility that it's the final flag in the bear trend. So traders will look for a reversal. Here's a 2-bar reversal, a bar down and a bar up. So a possible buy. We got 4 consecutive bull bars here as well. And a 6-bar bull microchannel. 6 bars without a pullback. So we're starting to develop some buying pressure late in this bear trend. The bears saw this as a bear flag, but instead of getting a bear breakout, we're getting a bull breakout. So aggressive bulls will buy the close of this bar, and they'll also buy the bar as it's forming, and they'll put a stop below, betting on a successful breakout and a measured move up based on the height of the bear flag. The first target would be a break of the top of the channel. This is what happened. We had a very big bull trend bar. Small tails, close on its high. Traders will buy that close as well and put their stop either below the low of that breakout bar or below the low of the beginning of the bull spike, the bull breakout. So we had some buying pressure at the end of a bear trend, and it led to the start of a reversal up. And this is what followed. Traders bought the close, a very, very strong bull spike, and traders began to treat this like a strong bull trend. Yes, we're starting to get a pullback here, and we're probably evolving into a channel, but it's a bull channel after a very strong bull spike, so the odds are high that there'll be higher prices that follow. So traders will be looking to buy. Stop maybe below here, maybe down here into this gap. The low of this bar is above the high of the bear flag, so we have a gap in here. That's a breakout gap. This might be a measuring gap, a very large bull bar. And that is the end of the module on buying and selling pressure. Thank you. I'm Al Brooks, and this is my price action trading course. This module has to do with always in, who owns the market. The most important fact about price action is whether or not the market is in a trend or in a trading range. The market always, on all time frames, is either in a trend or a trading range. And if you're not certain which it is, it's in a trading range. Trends are clear, and whenever the market is not clear, it's in a trading range. The market's in a never-ending cycle. It is either trending or in a trading range. And when it's in a trading range, it breaks out into a trend in either direction. Trends can be strong spikes or breakouts, all the same thing. And then after they've gone on a while, they start to develop some two-sided trading, some overlaps, some pullbacks, and they enter a channel. The channel evolves into a trading range, and then the trading range breaks out either up or down, and the process begins again. The market has inertia. It always tends to continue to do what it's been doing, and that's the way you should trade. If the market's in a trend, 80% of the attempts to reverse will fail. So you should trade in the direction of the trend. So if you're in a bear trend and the market starts to reverse, 80% chance that reversal will turn into a bear flag, and you should be looking to get short instead of looking to buy. Likewise, when it's in a trading range, 80% of the attempts to break out into a trend will fail. So you should trade in the opposite of the direction of the attempts to convert into a trend. So if the market goes above a prior high, it makes more sense to look to short than it does to look to buy. Again, if you're not sure whether or not the market's in a trend or a trading range, it's in a trading range. Uncertainty is the hallmark of a trading range. So whenever you're confused or not sure, the market's in a trading range. If you keep waiting for a pullback and it never seems to come, the market's in a trend. And if it's in a trend, you have to enter either at the market or within a few minutes, even if it's a very small position, because trends will go for a long, long time without giving a pullback, and you'll end up missing a big part of a very good trend. What's the always in direction? If you are forced to enter the market this minute, either long or short, whatever choice you make, it's the always in direction. Usually the choice is pretty clear, and you can almost always make a choice. If you can't, based on the past 2 or 3 or 4 bars, go back 20 or 30 bars and look for the most recent spike up or down. If the market's always in long, more dollars are going into the buy side. There's more buying. It creates more buying pressure. The buying pressure is stronger than the selling pressure, and higher prices are likely to follow, so you should be looking to buy. If it's always in short, more dollars are going to the sell side, and that will create selling pressure, and that's a sign that the bears are taking control over the market. Lower prices are likely, so you should look to sell. Once you know the always in direction, if it's clear, you should enter immediately or in a small pullback. And if you have to put your stop far away, that's what you do. You put it far away and then trade appropriately small. So if your stop is 3 times bigger than what you normally want it to be, trade 1/3 or 1/4 your normal position size. That's okay. There's nothing wrong with trading small. It's far more important to put any position on than it is to miss a trend. In a trend, prices move mostly in one direction. At some point, the breakout phase transitions into a channel phase, and a lot of times the channel may not be all that obvious to a beginner. They'll look at it and they'll see what they think could be a channel, and they'll deny that it can possibly be a channel. But it probably is a channel. A trend can be as small as a single bar. And remember, every trend bar is a trend. The trend can be as large as the entire chart. Characteristics of a bull trend: a series of higher highs and lows, and it's contained in a rising channel. The bottom of the channel is the trend line. The top of the channel is the trend channel line. Since a bull trend has higher lows and higher highs, as long as it keeps making higher highs and lows, the trend is in effect. So swing traders put their stop below the most recent higher low, because if the market falls below that higher low, the market's no longer in a trend, and they're betting that the trend will continue. If the market falls below a prior low, they'll assume that their premise is wrong. The market is no longer trending. It's either transitioned into a trading range or it has reversed. Bear trend has lower highs and lower lows, and it's contained in a falling channel. The top of the channel is the trend line, and below is the trend channel line. Again, similar to a bull trend, a bear has lower highs and lower lows. As long as the market keeps making lower highs and lower lows, stair-stepping down, it's in a bear trend. And because of that, swing traders put their protective stops on their shorts above the most recent prior high. So every time the market makes a new low, they go back and lower their stop to the most recent lower high. Because if the market rallies above that prior high, they assume the bear trend is probably over and that the market has transitioned into a trading range or possibly even a bull trend. There are many terms that traders use regularly, and there's no agreement among the terms. Here's a list of terms that describe movement within the market, and I'm going to give my definition for the use of the terms. A trend is a diagonal move up in a bull, down in a bear, and a trend occupies most of the screen. And there cannot be more than two trends on the screen at any one time. If there does appear to be more than two, I would not use the term trend. I would use one of the other terms. Smaller versions of trends are swings, legs, and pullbacks. A swing, it's a smaller trend, and there has to be at least two of them on the chart. They can be within a trend or within a trading range. So if you see two or three moves up or down on the chart, you can call them swings. Some people use swings and leg interchangeably, and I usually think of a leg as smaller than a swing. It's a small trend within a trend or a trading range, and a pullback is the smallest example of a leg. So if the market's in a bull trend and then it pulls back for a bar or 5 bars or 15 bars, that pullback is a leg, and the bull breakout and the resumption of the trend is another leg. A pullback is any pause in a trend. It can be a 1 bar pause, it could be 5 or 10 or 20 bars. As long as you believe that the trend will resume before long, the pause is a pullback. If it grows to too many bars and it loses predictive value, it's no longer a pullback and it has evolved into a trading range. A trading range can be as short as 1 bar or it can fill the entire screen. It's a pullback where the breakout direction has lost itself. You're not sure if the breakout will be up or down. So if you're looking at a sideways market and you're not sure where the direction of the breakout will be, you're in a trading range. Trading range is simply an absence of a trend. If the market's not in a trend, it's in a trading range. So if there's no clear trend on the screen, the market's in a trading range, and you should trade it like a trading range. Buy low, sell high, and scalp. Within every trading range, there are small trends. Within every trend, there are small trading ranges. So if you have a big trading range, there are small trends within it. Let's say you're on a 5-minute chart, and you're seeing a down leg. If you flip to a 1 or a 2-minute chart, that down leg could be a very strong bull trend. If you're looking at a very strong bull trend on the 60-minute chart and you flip to the 5-minute chart, you'll see that there are lots of pullbacks that are so big that they're basically trading ranges. Beginners are always waiting for pullbacks. They see strong bull breakouts, strong bear breakouts, and they know that they have to put their stop beyond the breakout. So for example, in a big bull breakout, they know the stop has to be below the bottom of the spike, which might be much further away than they want. They don't want to use that big a stop. They want less risk. So they're waiting for a pullback, hoping that they'll be able to enter with smaller risk. The problem is during strong trends, the market goes a very long way before a pullback ever comes, and beginners invariably end up missing huge trends because they're afraid of the big loss that would come from the wide stop. They're not doing what the institutions are doing. If you want to make money as a trader, you've got to be copying the institutions. And if the market is going up relentlessly bar after bar, the institutions are buying relentlessly bar after bar, and that's what you have to do. If you want to make money, you got to do what they're doing, and they're buying. And they know their stop is far away, and that's okay. But if you want to make money, that's what you do. You buy small, and you use the stop far away. If you are looking at a chart and you see a good reason to buy, and then you look at it again for another minute, and then you say, wait a minute, there's also a good reason to sell. that means you're confused, and that's the hallmark of a trading range. Whenever you are confused, you know that the market's in a trading range. So you should adjust your trading style to trading range type of trade. When it's in a trend, only take trades in the direction of the trend and try to swing part or even all of your position. You let your profits grow and train yourself not to exit too early. When the market's in a trading range, you always have to be thinking about doing the opposite of the current trend. So if the market is racing toward the top, instead of hoping for a breakout, instead you should be looking for a reversal. You want to be selling high, and you only want to be buying low. So you want to be buying when the market is racing toward the bottom and starting to reverse up. So the bear spike down to the bottom looks like it's going to break out, but 80% of the time it will not. Instead, you should be looking for a reversal. So trading ranges, you're always looking to buy near the bottom and sell near the top. In trends, you do the opposite. When the market's racing up, you're buying. In trading ranges, since the market races down and races up and races down and races up, you have to scalp, or at least that's the best way to trade. Always use protective stops for all trades, whether you're in a trend or in a trading range. And put the stops in the market, not just in your head. The stops are there to protect you. Again, the market's either in a trading range, here's a trading range, here's another trading range, or it's in a trend at all times. If you can't tell, then assume it's in a trading range and trade it like a trading range. Every bar is either a trend bar or a trading range bar. It's a trend bar if it has a pretty big body and small tails. It's a trading range bar if it has a small body and big tails. When you're not clear, always look at context. If there's a small body and a strong trend, it's more of a trend bar. If it has a bigger body but the market's sideways with lots of overlapping bars and big tails and lots of reversals, it's a trading range bar. Every tail that you see on the top or bottom of the bar is a failed breakout attempt. Remember, if you have a tail on the top of the bar, that means at one point the close of the bar was at the top of the bar, and the bar was probably a pretty strong bull trend bar. That tail formed because that breakout attempt failed and the market sold off into the close of the bar. So every bar is either a trend bar or a trading range bar. These blue bars are trend bars. Up bar, down bar, these are trend bars. These small bodies, prominent tails, these are trading range bars. So every bar, a single bar can be a trend, a single bar can be a trading range. Every tail is a failed breakout. So we have a tail at the bottom of the bar. At one point, the close of this bar was down here, below the low of the prior bar. So it was a strong bear bar breaking out below the bottom of the prior bar. But by the time it closed above the open, and it became a failed breakout. Here's a failed breakout above the top of the developing range. Sometimes you get two-bar reversals, and the tails at the bottom are failed breakout attempts. Every trend bar, even a single trend bar, every series of trend bars is a breakout. I also call it a spike. Every trend bar is also a gap. You can call it, sometimes it's a breakout gap at the start of a trend, a measuring gap in the middle, or an exhaustion gap at the end of a trend. So every trend bar is a gap. Even though you don't see a gap on a 5-minute chart, you should think of every trend bar as both a breakout and a gap. It's also a climax. Sometimes it reverses, sometimes it does not, but you should think of every trend bar as a breakout, a gap, and a climax. Remember, every trend bar is a breakout, a climax, a spike, and a gap. And a lot of times you don't know which it's functioning as at the time it's forming, but a lot of times the context will tell you. Here's a breakout, closed below the low of the prior bar, a very big trend bar. Breakout is also called a spike. Here's a spike up, an upside breakout. We broke above a channel, and we broke above a trading range. It ultimately failed. Here's a bar where the close is below the low of the prior bar and below the low of the day. So you can think of it as a gap, but the market reversed up. The market had been trending down for about a dozen bars, and this big trend bar functioned as an exhaustion gap, the final gap of the trend. Here's an exhaustion gap at the top. There's a gap between the high of the bar before it and the low of the bar after it, and the gap filled and the market reversed down. Sometimes you get a breakout of you get a bear breakout of a bull flag, and you have to be thinking that it might lead to a measured move. So here, this gap functioned as a measuring gap. And you can see the market turned around the measured move down. Every gap is a trend bar, but every gap and every trend bar is also a gap. On the right is the 5-minute E-mini, and there's a gap open, and that is the same as a trend bar. On the left is the cash index, the S&P cash, and you can see that the 5-minute futures contract had a gap, but the 5-minute cash index had a spike. So functionally, a gap and a spike are the same thing. Here's an example of two ETFs. Here's the FAS, which is a financial futures leveraged ETF, basically the XLF with some leverage. On the right is the RKH, which is also an ETF comparable to the FAS and the XLF, but the volume is much thinner. And look at all these gaps. You can see actual gaps because the market's so thin that no trade takes place as the price jumps from place to place. But look on the chart on the left, on a chart with heavy volume covering the same basic underlying stocks. Instead of gaps, we have trend bars. So functionally, a gap, here's a trend bar. You should think of every trend bar as a gap and every gap as a trend bar. When a gap occurs at the beginning of a move, it's a breakaway gap. When it occurs on a breakout here above a lower trading range, it's a measuring gap. When it occurs late in a move, you have to wonder if it could be an exhaustion gap, letting you know that the market might be trying to pull back or reverse. Every trend bar is a gap. Here again, RKH versus the FAS, similar financial future ETFs, and you can see that all the trend bars in here are gaps over here. I have the corresponding bars numbered. So for example, the move up to bar 5 here is composed of 3 bull bars, and bar 5 here is composed by a couple of gaps. And that is the end of my module on Always In, Who Owns the Market. Thank you.